barely audible.
This meeting is being recorded.
Yeah, so people request to mute your mic from your end during the session, when the session starts. Morning, Jitesh.
Hi, good morning, everyone.
Yeah, thank you,
Hi,
Jitesh.
morning.
I think we have Mr. Sankalpa and Mukesh joined. I haven't joined Jitesh. We have to wait for. I think we have to wait for Mr. Pushkar and Ankit. Then we will start. Yeah, Pushkar also joined, I guess. Morning, Mr. Pushkar.
Hello, sir. Morning.
Thank you.
Hello, everyone.
Hey, hi, morning, Pushkar.
Hi, Pushkar.
Yeah, morning, Mr. Ankit. Mr. Ankit, you can unmute the mic from your end. Hi, Ankit.
Hi.
Yes, I think all the speakers have joined. Mr. Sankalp, can we go ahead?
Yes, please go ahead.
Thank you. Thank you all. I'm happy to welcome you all today for the session on last mile logistics, opportunity for startups. I would like to give a small brief about the ICONN. ICONN is a first of its kind industry-led platform for the startup ecosystem. ICONN promotes corporate startup connect, strengthens startup ecosystem in India, and also international engagement. The idea is to help build an ecosystem that encourages innovation-driven entrepreneurship by facilitating strategic conversations. Last mile logistics, which is the most challenging and resource-intensive part of the logistics network, is gaining increasing importance in India. The network has evolved rapidly over the last few years. Having received a major push since the onset of COVID-19, the sector is expected to witness a strong growth. Startups working in the segment have developed AI-powered platforms to enable real-time and predictive tracking to simplify the end-to-end logistics operations. In the last mile segment, startups have set up seamless virtual onboarding processes to onboard delivery agents. CII, along with PwC as a knowledge partner, organizing this session on last mile logistics to discuss the future of India intra-city logistics from the lens of demand-supply dynamics and increasing tech synergies in this sector. I would like to welcome the panel moderator, Mr. Sankalpa Bhattacharya, Deals Strategy, Partner and Leader, PwC India, to take over the session. Over to Mr. Sankalpa. Thank you.
Thank you, Hari. Before we get into the meat of things, maybe a quick 30-second introduction from the panelists, starting with Ecom Express.
Yeah, hi.
Hi, we can hear you. Please, just quick introduction would be great.
Yeah, this is Vipul Agrawal from Ecom Express.
Thanks, Vipul. Arvind?
Hey, hi, morning, everyone. My name is Arvind. I represent EMISA. I lead the last mile business and other multiple initiatives within EMISA. To give a quick, small introduction about EMISA, we are a supply chain enabler of consumer brands, where we provide end-to-end solutions through our network of fulfillment facilities and last mile delivery partners to largely create an Amazon Prime-like experience for brands that we work with. We currently are present in about 8 cities with about 17 fulfillment facilities.
Thanks, Arvind. Mukesh?
Hi, good morning, everyone. My name is Mukesh Agrawal, Deals Partner in PwC. Logistics clearly is one of a large focus sector for me. The last decade or so have been involved in a large number of transactions across these subsectors within logistics, including trucking, freight forwarding, CFS, ICD, last mile logistics, and also e-commerce logistics. So glad to be on this panel.
Thanks, Mukesh. Jidesh?
Hi, this is Jidesh from Delivery. I lead up the entire last mile and returns operations across all the business lines of delivery.
Thanks. Pushkar?
Thank you, Sankalp, sir. This is Pushkar here. I represent Let's Transport. We are a last mile trucking aggregator focused on regional logistics and regional transportation for large enterprises in India.
Thanks. Ankit?
Hi, this side Ankit Kaushik. So I head operations at Picker. Picker is a supply chain logistics enabler with focused on mostly last mile logistics, warehousing fulfillment, and technology. Glad to be a
Thanks,
part of this panel.
Thank you, Ankit. So today's session is on last mile logistics and interesting evolution that we've seen for the sector. I remember when I started my career in the FMCG industry 20 years ago, my last mile mode of conveyance was a bicycle, and often it was a tempo. I've even done horse-drawn carts and bullock carts, and what a difference a decade has made, right? So most of the panelists out here are with companies who have been around for less than 10 years. And it's been a massive change in last mile logistics in these 10 years. And just to give you some statistics on where things are, we have around 230 million online shoppers today, which is a massive growth, right? 10 years back, there was hardly any online shopping happening in India. Most of the marketplaces weren't even around in the country. And this 230 million is estimated to go to about 600 million online shoppers in the next 10 years. There's about $50 billion which is spent online, which is the e-commerce market in India, $45 to $50 billion. That is expected to grow 6x by 2030 to about $300 billion. As compared to the retail industry, which itself is growing at 9 to 10%. And we'll discuss in this panel how the retail industry is itself transforming and getting into omni-channel and using last mile logistics as a key enabler for business growth and transformation. 50% of Indian households today have internet access, and that's estimated to go to about 80% by 2026. So all of this growth really is underwritten by very solid growth drivers. 61% of the population in India have a smartphone. Again, that's estimated to go to 80+% in the next 3 to 4 years. And overall, if you look at the retail industry, that's valued at about $700 billion. And we've seen before the pandemic, through the pandemic, and post the pandemic, a number of retail segments which have seen phenomenal growth online, whether it's food and grocery. And we all can remember the days when we used to order online for groceries because it was just not possible to step out, all the way to restaurants, which enabled home deliveries, to consumer durables, and also apparel, jewelry, footwear, and more recently, beauty and personal care through some of the D2C brands that have come up in the country. And if you look at the $700 billion of retail spend, historically, the share of online has been very low. It's usually been less than 2%, but the current situation is very different and evolving. So for most retailers, online is about 5 to 10% of sales. So online and last mile logistics and D2C is something which just cannot be ignored. And if you look at the size of the D2C logistics industry from virtually nothing about 10 years back, it's grown to about $8 billion. 70% of that is last mile, and about 30% of that is fulfillment. So let me maybe start off with a question to Jidesh, right? So Jidesh, you've been one of the key participants in this journey over the last 10 years. Help us walk through what have been the key changes which have enabled this explosive growth for the last mile logistics industry over these 10 years.
Hi, Sankalpa. Thank you. I hope all of you can hear me clearly.
Loud and clear.
Okay, great. So I think, like you rightly mentioned, right? I think the growth of deliveries coincided really well with pretty much the sheer boom that we've seen in online shopping, the boom of the startup ecosystem itself in terms of e-commerce and so on. So that's really sort of helped us grow, right? We started in FY12, and as we've completed a 10-year journey, I think it's coincided very well with the external market. Now, and the amazing thing is that, we continue to see massive growth in terms of, whether it's new customer acquisitions, even as of last year, right? At our scale, in our core express business, we've seen like a 55% growth, just last year to the year before that, which has essentially been an impact of COVID, and what we believe is even faster acceleration towards digital means of shopping, online commerce. Right? So, yeah, I don't think there's a single inflection point that we can really identify, even in our entire 10-year journey. It continues to be driven by the explosion of, in a business like ours, it continues to be driven, of course, by the explosion of consumers buying more and more online, one. What we are also observing is that even in the B2B space, right, and that we are a fairly large player in the B2B space, we are seeing more and more companies wanting to work with logistics players like us, wanting to essentially digitize the supply chain. And all of this is essentially leading to the boom that we are seeing in last mile logistics. So it's not just, what we call the express or the B2C piece, but it's also essentially the B2B piece, and all of it lends very well in terms of our ability to expand unparalleled coverage.
Thanks, Jidesh. Let me kind of switch over to Pushkar. So Pushkar, you not only serve some of the e-commerce customers, but also some of the traditional FMCG and retail customers, right? And I talked about that share increasing constantly. What's changed in the thinking for some of these traditional retailers and consumer companies in really adopting last mile and outsourcing much more on that front?
Absolutely, Sankalp. So just building on to where Jidesh left, I feel, even these small retailers, wholesalers who were part of the downstream operations from, where they would hand their goods over as a brand, they now themselves in a personal space have started experiencing Swiggy, Zeptos of the world, and in their personal space, they're experiencing a 30-minute delivery, a 10-minute delivery, so on and so forth. And that's what's led for them to demand back-end enterprises as to why can't their supply chain get augmented to that certain specific levels, right? And I think this entire wave was probably, the fillip was given during COVID, where everyone, even the remotest retailer of probably a tier 2, tier 3 was experiencing some form of e-commerce in his own personal space. And I think that, as per me, is definitely a significant inflection point. Just building onto that, I think now enterprises are open to digitizing and consolidating their supply chains, largely to deliver that kind of end experience, right? Prior to starting Let's Transport, I was with ITC, and I've seen at close quarters of how we have started changing or looking at the way we were looking at supply chain from a ITC or probably a Unilever's lens. And I think people are now, sooner than later, every large enterprise would have some element of digitization in their entire supply chain. So it's either, probably Amazon going closer to a delivery by or going closer to an Unilever by acquiring Whole Foods, or the vice versa. But both of them are at an inflection point where even Amazon would need digitization, and even a traditional outfit would need digitization.
Thanks. So Ankit, let me kind of pass that question to you. I think both Jidesh and Pushkar mentioned COVID-19 as kind of like a blessing in disguise or a transformation for this industry, right? What have you seen change before the pandemic, during the pandemic, and after?
Yeah, so definitely the pandemic created a kind of a ripple effect in terms of people starting their own businesses, because like during lockdown, people had time to ponder over things. They found out the gaps between different areas with different categories also. So definitely we saw a spurt in the number of smaller sellers signing up on the platforms and trying to actually digitize their supply chain, outsource it to us, and giving it us to handle the last mile logistics. pickups, fulfillment, things like that. Because so the drop shipping model has really caught up into this. And definitely we are seeing a number of categories spurting up, like apparels, D2C brands, in D2C brands specifically in FMCG. So beauty brands are coming up. And so they are using a number of solutions, not only with us, but different aspects of their whole supply chain, not just fulfillment, but even in manufacturing, there are many brands coming up. So let's see how long it goes. And even the ratios of COD and prepaid orders have kind of split between and reversed. So yeah.
Thanks, Ankit. Let me ask Arvind a question around customers, right? So you've had the e-commerce boom led by some of the online marketplaces, right? The large players. But you also have more recently traditional retailers that Ankit and Pushkar spoke about. You have large consumer product companies like an ITC or an Unilever. And more recently, a whole clutch of D2C companies, which have really come up and they are much more agile and they have access to market like never before. How are customer expectations different across these different sets of customers? And maybe you can focus on D2C. I'll kind of pass the question around for the other customer sets.
On the D2C side, what's essentially happened is the whole post-COVID era. There's something called pre-COVID, post-COVID. Post-COVID era, everyone, as Ankit rightly mentioned, everyone got time to ponder. They all realized that there is a convenience and comfort of going online and shopping. You had the players like DMart of the world who would come and deliver to your doorstep. You didn't have to stand in queues or call up your local Kirana stores to get the orders delivered. You would rather go online, place an order. Besides that, eventually then we saw journeys of on-demand deliveries where the Zeptos of the world kind of inched the whole expectation up by saying that, hey, I'm going to be delivering your order within 10 minutes. So that kind of is currently, I think everyone's trying to test the waters on the whole speed delivery, quick commerce space. Everyone's trying to figure out whether how ideal it is. But the whole new generation, especially the ones who are in their early 20s and in their late teens, they kind of are excited about the fact that, hey, I can order things quickly. I don't have to go to the retail stores or the malls like what my parents did to go and make any purchases. They want the deliveries faster. The patience to receive anything has gone down. This has also seen a spurt in a lot of orders that we see on the food space, where Zomato and Swiggy has actually raised the whole bar in terms of getting these orders faster within 30-40 minutes. Anything that you order, you could get it delivered. And that kind of now is extending to the other categories on the D2C side where food is taken care of. Now let's figure out the whole D2C space where how could we get it delivered within 30 minutes, 40 minutes. Dark stores have come up. Now dark stores are trying to replicate what something like a retail Kirana outlet is, just that they have systems integrated with their last mile network and their backend operations, where any order that a brand receives, they are able to advise brands in terms of replicating inventories across different facilities and getting these orders delivered within 4 hours, creating a wow experience for the brand. So the expectations have raised. And India, luckily, most cities are dense clusters. So the demand is always there. The demand only keeps increasing. And the network keeps, the network is always at a stage that it has to keep leveling itself up at every 6 months.
Thanks, Arvind. Let me kind of move to Mukesh, right? So you've seen many of these companies in the last mile space over 10 years, and of course in the traditional space for a longer period of time. Help us understand how the business mix has changed for last mile logistics companies over these 10 years, especially during COVID, right? Did you see a sharp spike, and do you think some of that is sustainable? I think as Ankit raised his point.
Sure. No, so Sankalpa, I think the business mix has certainly changed. I think we have seen this whole the e-commerce, the retail D2C coming in, and that clearly had a significant impact. The way this whole and I'll kind of focus more on last mile logistics, so that the way it has impacted the last mile logistics. And COVID clearly has kind of changed a lot of things, be it in terms of volume accelerating, this whole the supply chain and adoption of technology. Sankalpa, am I audible?
Yes, go ahead, please.
Hello.
Yes.
Yeah, sorry, so Sankalpa, but if you really look at one thing which is quite interesting, which I have noticed over the period, is how this whole evaluation has also impacted this overall unit economics for the last mile logistics players. So if we really look at the trend over the last 4 to 5 years, there has been a constant pricing pressure on let's say the e-commerce logistics players, and I mean both delivery and e-com are on this call, and due to a couple of reasons. Firstly, there is increased competition, there are higher volumes, there is pricing slabs, etc. So to meet that, actually the last mile players will also have to kind of react to that, because if there's a pricing pressure on the revenue side, one would kind of their strategy on the cost side. And fortunately, to a large extent, the cost side also, the players have been able to contain the cost and optimize their operations. So if I can mention 3 specific trends or things which I have seen on the cost side. One is the better optimization of the manpower. So, the per person delivery, if you really look at, has improved almost, let's say, by 50-60%. So that has helped. The second thing is this overall fleet utilization. And the last thing is the adoption of technology. So better uses of capex, technology, like using the sorters and all in the fulfillment center. So I think there has been a lot of evaluation that has happened, and also with this whole e-commerce penetrating into tier 3 cities and the rural India, and where the cost of delivery is slightly high compared to if you look at tier 1 tier city, and that's the area where probably the last mile players would have to kind of focus a bit more on to optimize on the cost side.
Thanks, Mukesh. Maybe Jidesh, I'll pose this question to you. So Arvind talked about D2C, and that's an emerging trend. But you've been one of the leading service providers to the marketplaces. What's next for them? Don't they deliver everywhere already?
Well, they do. But at the same time, we're still continuing to see fairly phenomenal growth as far as some of the marketplaces are concerned, right? So I truly think that this, and we are observing a significantly larger number of sellers who are coming online, buying online. So it's, not to sound cliched, but I think we are really seeing the Great Indian Bazaar moving online. And that is making a difference. So do they sell everywhere? Yes, they do. But I still think it probably represents a very small percentage of what's the market out there. The sellers are more concentrated. It is, what we are observing is that the sellers who are coming on board, the sellers who are the early adopters, and the growth really comes from few pockets. You've got the Surats of the world, the Surats, Jaipur, Delhis of the world. I mean, these are really the places from where a lot of the seller growth is coming. But consumers, I think, are just relishing the idea of being able to have some of these products available in the Northeast or in different parts of the country. So that's really what's playing out. The D2C piece is more interesting because I think in the D2C space, what is invariably happening is that we are seeing, and that's logical, right? For a lot of D2C brands, we are seeing that a lot of the demand is very, very metro driven. It represents consumers at a certain socioeconomic class. I think the D2C brands are pretty much going to lead or sort of force companies like us to also innovate more on the last mile, because that is where a lot more demands are coming from in terms of same-day deliveries, faster returns, faster reinventorization, and so on. So I think for the larger marketplaces, it is going to be about penetrating the market more, ensuring that we are able to reach to all corners. Whereas for D2C brands and stuff, I think it's going to be differentiating the offering, same-day delivery, same-day returns, rapid reinventorization, ensuring that a much smaller consumer base that they are all said and done working off has a superior experience. And the brands realize that the logistics part of it, the delivery experience of it, is as core to retaining them. Otherwise, it just doesn't make sense for them. That's pretty much how we're seeing this play out. Yeah. And just to comment on, sorry.
Go ahead, please.
Yeah, just to comment on the cost piece, right? I mean, since Mukesh just brought that up, I think, yes, we are seeing that, right? Like if I look at delivery, over the last 3 years, what we've observed is that if I talk in terms of yield per parcel, we've essentially had to drop yields by 20% plus, right? So that is a pricing pressure, right? If you see some of the key costs like fuel, right? In that same time period, fuel's gone up by almost 50%. And yet, what we managed to achieve is that our EBITDAs go up by 4x. So I think in businesses like this, the leverage comes from scale, right? There is going to be essentially cost pressures. There is going to be pricing pressure, and we will have to continue to react to it. But I think once we are operating at a certain scale, and of course, additional leverage is coming from technology. Mukesh mentioned the sorters, larger trucks, better utilization, better tech, all of that plays a part. But I think the fact that we are operating as an integrated logistics platform or a provider is really what gives us the leverage. I think it'll be extremely difficult if you're going after any one specific piece. Or let me put it this way, I think the challenge to respond both to the pricing pressure and yet the inflationary pressures and cost would be far more difficult if you do not have that kind of a leverage.
Thanks, Jitesh. Let me kind of go back to Ankit on these 2 points, right? So speed and scale, we had that discussion just now. Are 10-minute deliveries real, and will they last? And tell us a little bit more about scale and this operating leverage and the ability to price and absorb some of these cost inflation, because you're in a different stage of your evolution. So if you can just touch upon this 10-minute delivery and leverage point, that'll be great.
Yeah, definitely. So basically 10-minute, let's convert this 10-minute delivery to a 1 to 2 hour delivery for e-commerce sakes. So 10-minute delivery is logical and seems good in the food category or the pharma category, but in e-commerce space, people don't want 10-minute deliveries. So let's suppose a quicker delivery can happen only if you infuse in more dark stores, put in localized inventories, and build a network of people plus, you can say, inventory plus dark stores in a very dense kind of a network. So that's how it will happen. And definitely creating this kind of a network will have its own cost, operating cost plus fixed cost. And this is how the overall pricing of this 10-minute delivery is increased. And so brands, particularly with a higher ASP, can definitely afford this kind of a 10-minute delivery. But brands who have an ASP of, let's suppose, 200 to 300 rupees, won't be focusing this much on the quicker delivery part. They are fine, and even their consumers are fine with a 1 to 2 day deliveries. So currently, as a company, as Picker, we are focusing on creating a 1 day delivery network in major metros and the major tier 2 cities of India. And that's how the major of the demand is being driven by. And brands are also expecting us to build this kind of a network. There are some instances where we get very steep demands and steep kind of, you can say, expectations, but that's how the balance has to be maintained. And definitely you can see like the price, since this is a festive season, you will be soon seeing prices being slashed and people getting very cheap goods. So this can't happen in a, you can say, 1 to 2 hour delivery space. This can happen on only 1 to 3 days. And sure, yeah.
Thanks. I'll touch a little deeper on those two areas of unit economics and expansion, and I'll come around to questioning on how those two are linked. But Arvind, you started off in your intro saying that you're present in 8 cities. Why not go to more cities? What stops you?
So essentially for us, what we've realized is we need to maximize two things. One, we need to maximize the serviceability to the consumption clusters of India. And second is have networks, logistics networks like delivery, e-com express closer to our facilities, which can enable us to get these deliveries faster. Now, if I account, we are currently present in the NCR region. In South, we are present in Hyderabad, Bangalore, Chennai, and on the western side in Mumbai. And then on the eastern side, we are present in Guwahati and Calcutta. This largely represents, this can cater to close to 85 to 90% of the consumption clusters in India. As far as the balance 10% is concerned, it's still an uncharted territory for us, but everyone's going through their own iterations to figure out how best they can service. Now, with each of these facilities, what we have, most of the brands are located in and around these facilities. One, they want to optimize their costs. They want to ensure that the order to delivery TAT is faster, which I can do it. Say if I receive an order from Ludhiana, I'm faster to cater it from my NCR facility than a facility from Mumbai. Today we are seeing more and more brands who are replicating inventories across multiple facilities as their scale of operations are increasing. They want to reach faster. Now, would having a facility in a tier 3 city today help them? Maybe not. They have not reached that life cycle in their journey where probably they have enough orders from every pin code where we can set up a facility and maximize. So from that perspective, we largely feel that the maximization is essential from these cities, and we see more and more demand coming in terms of these cities where we've had almost multiple facilities within each of these cities to cater to the growing demand. So largely it's maximization and catering to the larger consumption clusters in India.
Thanks, Arvind. I'm going to follow that through with a question back to Jidesh. Jidesh, you've been one of the key participants in this battle for pin code dominance, right? You've taken a slightly different view that we'll be everywhere we can be. How do you react to Arvind's point that being in 8 cities gives you access to 90% of India? So why go beyond those 8 in terms of fulfillment centers?
In our case, that's actually not true in the way our volumes play out, right? We continue to be a company where the vast majority of our volumes actually come from tier 2 and beyond pin codes, right? We also believe that in terms of just the value proposition, right? Just a value proposition to a diverse set of clients, not just people who cater to the B2C segment, but even our B2B segment. Reach is extremely important, right? And so to that extent, we pretty much cover most of our addressable pin codes. And like I mentioned, it is a function of scale. It is a function of scale which allows us to do that. Again, I think as purely from a last mile standpoint, right? We would like to be the company that says that we can get your shipment pretty much delivered anywhere, right? And as long as there are clients who see value in that proposition, as long as we have paying clients for that, we will continue to offer services, right? Our unit economics, and I think I mentioned this earlier too, ultimately it is a service that we price in. And as long as there's client demand for that, that's perfectly fine.
Thanks, Jidesh. Let me turn over to Pushkar. What do you think about regional expansion and concentration of demand within a few centers? You do work with a number of FMCG companies as well, right? And they of course have been around in India for decades, in some cases centuries. How do they come to you and say that, or do they come to you and say that, look, we want to use you guys only for delivery in a couple of cities, or help us get to the last mile in the remotest of locations? And how does that impact your expansion plans?
Sure, absolutely. So Sankalp, the reason why I started this was from a personal experience back in when I was in ITC, right? And the challenge was we would often lose out on sales because the stocks would not reach on time. So think of where Sankalp walks into a retail outlet, asks for a bag of Ashirvad atta, and they say, the retailer says Ashirvad nahi se Pillsbury le lo. That you might be agnostic to that switch, but that typically tends to lose out about 15 to 20% sales for large brands in India. And fortunately / unfortunately, that was my management trainee project in ITC. So when I started researching about the entire value stream of where actually goods are flowing, what I did realize that usually the long distance trucking, right, which has been dominated, or what we call it as primary freight, moves, where you're moving products from factory to, say, state warehouses to regional warehouses, or probably warehouse in Bhiwandi, that has been dominated by family-owned large traditional trucking companies. So you have the likes of TCI, CJ Darstals of the world. But beyond that, there is a leg where where you're moving products from that warehouse to retailers, distributors, or even to say a tier 2, tier 3 and neighboring cities. That part essentially is extremely fragmented. So when we talk about regional logistics, these are these use cases that we're trying to solve for. And hence we're there in about 20 states. So technically we cover most of the Pareto top 80% of tier 2, tier 3 and larger cities that one would want to reach to. Now, the problem of this industry was traditionally large companies or incumbents weren't willing to dabble into this sector, largely because your average order values are very small. So if you're moving a truck from, say, Bhiwandi to Andheri East, which is a 50-kilometer run, you're technically going to pay about 1,000 rupees for that. While if you move a truck from, say, a Haridwar factory to a Bangalore, you would probably be doling out about 1 lakh rupees worth of freight. And interestingly, the rate determining step of this business is managing a truck driver, right? And it's a very intuitive way of looking at this business. That's how family-owned businesses have been looking at it. Now, it's easier to manage a single driver, get 1 lakh rupees worth of revenue and probably a 15,000 rupees worth of net revenue, versus managing 15 drivers to get the same amount of money. So in these smaller transactions, your effort to reward ratio is never justified. Which is why even in an ITC's context or any other context, you would have organized partners for long distance trucking, but you would have to deal with individual truck owners for shorter transactions or shorter distance runs that we typically call it for. And it's the last leg where essentially all of your sales loss happens. If you open a balance sheet of large companies, you would see inventory days kafi hai inventory ke paas, right? There are about 20 odd days of inventory lying in the entire value chain. And then it's technically impossible ki retail pe nahi mil raha hai maal. The only reason is because your last leg of journey is not scientifically determined at the back. And that is essentially what we're trying to solve. So I think coming back to your question, I think, the way brands approach us or we approach brand is essentially helping them solve for the sales stock out problem. Technically, in a limited set of category of, say, between 500 kgs to 10 tons in size, there are 50 possible SKU trucks that's available. And real-time availability of these trucks is a challenge, which is why products placement and fill rate becomes a challenge for these brands. And that's the problem that we're trying to solve. And what Jidesh was saying, essentially where you have integrated service offering, which essentially allows you to have network benefits. We believe that if you go vertically deeper into each leg of the movement, you're probably, you can generate a tad more efficiency than probably looking at multiple sectors of logistics as such. And we've seen that operating leverage play out in the past for us.
So let me kind of ask an interesting question. Arvind said I can serve Ludhiana from my NCR fulfillment center. Let's say you have 50 bags of atta, which ITC asks you urgently to move to Ludhiana or, God forbid, Moga. How would you do it within a day?
So we do not have warehouses, right? So technically we would pick products up from a particular distributor center or a warehouse and then move it for them any part of the world. So the way it happens is ITC would have a lot of distributors / wholesale units in a state of Punjab or, wherever we are looking at. We would look at the nearest pickup location, pick it up and drop it for them. And that's how we would solve for those problems for them.
Mukesh, I want to come back to you on this point around unit economics. Jidesh made an interesting point that even if I have a presence in a remote location, I price it in for my customers, right? So unit economics has become very important. Do you see that really playing out across the industry, or do you really think that there has to be a sacrifice of unit economics in favor of growth as you're going down the city tiers?
Right. So Sankalpa, the way I look at this as it's more of a strategic decision, right? So strategic choice which one would need to make. Now, when it comes to e-commerce logistics, again, I mean, the game there is very, very different. I think having presence in a larger number of pin codes clearly gives you a competitive advantage. Right now, what Jidesh also mentioned is there's a possibility that if, let's say, they are operating in 25,000 pin codes, right? Maybe some pin code 1,000, 2,000 may not be, on a standalone basis profitable, right? From a unit economics perspective, from a profitability margins perspective, that those may not be profitable. But again, I mean, it's a thing that how that thing is overall dovetails into the overall business and the strategy of the company. So, and I've seen that closely in a couple of at least e-commerce logistics players that, I mean, that's a call they kind of tend to that just to kind of get a competitive advantage over others.
Thanks, Mukesh. So one of the points which I want to touch upon a little more is people, right? So none of these businesses can run without people, and we've seen this massive war for talent. In some cases between all of you, in some cases between y'all and some of the traditional players, whether it's hospitality, retail, and a number of other industries, right? So let me start with Ankit. So Ankit, how do you manage this, this people equation, right? From hiring to retention to productivity, and through all of these peaks and some of these troughs that you talked about, right? How do you kind of get the engine going with so much uncertainty and attrition?
Yeah, definitely. Since COVID has already given this trend of work from home, so at least some of the people working at Picker are kind of more relaxed. So at least the attrition has been controlled to some extent. And definitely we are seeing a lot of tech talent and you can say business talent being shifted onto different parts of the logistic industry. Previously, there was some, you can say, inertia in moving to different, you can say, different kind of industry like logistics. So we are not definitely looking between different companies of competitors, but from outside the industry as well. So that's how people get a taste of how logistic works, what are the different aspects in it. And definitely, since brands are promoting us, brands are actually pushing us to drive innovation. So there are a number of newer projects that are coming out. So it kind of initiates the gray cells in the brain. So definitely people are looking us to build newer things and get new products going on for the brands and for the different halls of logistics. Yeah.
Let me move to Arvind. Arvind, people issues, attrition, how do you cope with growth with all of this uncertainty?
So largely what we've tried to do is each facility of ours is an independent P&L for us. And we try to ensure that we do not overstack ourselves. We try to solve problems through technology, where how could we be more efficient in terms of our day-to-day operations? What is the kind of workflow that we would want to have within our facility, which can minimize friction points in terms of a manual intervention being required. From that perspective, most of our facilities are leaner, which kind of helps us to be sure of, from a hiring standpoint, that at any point in time, I'm able to scale even if there is a seasonal surge. In addition to that, we also we work very closely with contractors, regional contractors in every areas where we have a presence, who have access to the people in and around, where most of these are unskilled. On the shop floor level, you largely need sort of unskilled folks and a mix of skilled folks who are more tech savvy. Luckily, for a country like India, more and with Geo, it has kind of helped that most of them are digitally, have equipped themselves in terms of understanding, transactions. How do I do my pickup? how do I do my put away operations. So from that perspective, what we've largely seen is one, we've kept it lean. Second, we have continuous engagement at every warehouse level. And third, each facility of ours is a P&L, which kind of ensures that the warehouse head is actually driving it as his own in-house business, which kind of ensures his KRA is to ensure that the teams are well knitted, working together. And then we also have rotations across our other facilities, which kind of motivates them to understand more what is happening with every brand that we work with. Some of the ways, but again, there is no perfect thing. We do face attrition. We do have folks who come in and say that, hey, now probably we don't face the kind of challenges what a delivery or an e-com express would face, because on the delivery side, the cost can just shoot up when you have the Zeptos of the world coming and saying that, hey, I'm going to double up your pay. We largely work in regional pockets, so that kind of gives us an edge as well. But again, we are not immune to the fact that there is attrition. There, we will keep facing that as new and newer players continue to enter the foray.
Jidesh, you have 60,000 partners who you work with, which perhaps is the collective population of a few island nations, right? How do you manage to hire so many, retain them, manage costs when they're offered increments every couple of months? How do you manage this whole thing, including some of the other people related issues like unionization, fair wages, etc.?
It is an incredible challenge. And I think especially in the last mile piece, that's probably the largest challenge that we face, right? So one is, of course, if you're talking attrition, I'm just keeping corporate attrition out of it. Corporate attrition, I think, barring tech talent, which I think everybody relates to, is not that much of a challenge. And I think as a sector, we are noticing that more and more people across teams, like Ankit mentioned, are willing to test out logistics as a sector. It's exciting and so on. Last mile, the real problem is essentially at the ground level, the riders. Right? That is really where the attrition is the maximum. It's a problem. I mean, there's obviously no easy solution for it, or we would have implemented it by now. It's a combination of things. I think as a company, we are constantly thinking of how to essentially diversify the segments that do come into doing last mile delivery. I think we'll have to complement this with many other models, whether it is expanding the Kirana network, in some very small pockets, sort of taking the lead and exploring things like lockers. So I think it's going to be a combination of things that's going to essentially tackle this capacity challenge. But coming back to purely the people side of things, I think all said and done, I do believe that as a company, we have a responsibility to ensure that we are, providing a safe working environment, obviously meeting, minimum wages and above. That goes without saying. That's sort of minimum to play. The softer aspect is what I think is often overlooked, because just because we are this, what sounds like a large army of delivery boys, does not mean that you necessarily look at that as, look at it in a rather commoditized manner. I do think that, and that's where a lot of our efforts are going. Right? A lot of our efforts are going to say, hey, in spite of that, we have to ensure that the riders are treated with the right level of empathy. Are we spending enough time ensuring that our facilities, our peripherals, when I say peripherals, it's about ensuring that, do they have the right kind of mounts so that they're not, using the phone in an awkward manner when they're riding? Are their bags more comfortable? I think sometimes what happens is if you only look at one dimension, which is to optimize for operational efficiency and cost, sometimes we forget whether all of our processes, peripherals are designed keeping the user at the center of it. And that's something that we are increasingly investing more in. And we are seeing positive impacts of that as far as attrition and so on is concerned. We are also in pockets toying with the idea of having delivery boys completely as on-roll employees. This is something which I think the sector has been rather averse to for various reasons. And we've been exploring this in pockets, and I think it's a program that we will expand more and more going ahead. Of course, given the extremely large base on the top and the steep pyramid that comes on top, providing career advancements within, say, last mile would be an extremely large challenge, and it's a promise we won't be able to live up to. But that's exactly where, again, the fact that we have various other operating units comes in, and we've been trying to see how we can, for some meaningful population, show a career path, even if you start as a rider, right? I mean, just to put it in perspective, my senior director of mine, who essentially handles the whole of North, pretty much the second largest area for us, started his life as a delivery boy, right? So we do have some of these spectacular growth stories too. So yes, I mean, long story short, capacity is a challenge. We are taking a lot of different steps to tackle it. I don't think any one step is going to arrest it. The largest challenges will continue, I believe, to be in the metros, but what is a problem in 4 metros today is going to become a 6 metro problem tomorrow and a tier 1 problem day after. So I think as companies, we've got to constantly figure out how to stay ahead of that. It's just no other way.
Thanks, Jitesh. Pushkar, I want to kind of ask for your views on the other challenge that not just your industry, but a number of other industries are facing. And I think in the last 6 months, a lot of the VCP community are beginning to sound like the cast of Game of Thrones and saying winter is coming, right? So how do you see this funding crunch impacting growth for you? And how are you preparing for that winter?
Absolutely. I think, Sankalp, it is fairly true. But I think none of us present in the panel over here come from an industry where we can afford to burn a lot of capital. We operate on wafer-thin margins, and hence, luckily, I mean, fortunately, I think all of us have a very frugal cost structure. And inherently, that's what logistics is. Someone did advise me this early on in my career that, look at the gross margin of this industry and then, kind of build your cost structures. I think what we've been very frugal about is the way we spend both on direct expenses as well as corporate overheads. We do keep investing in corporate overheads, which essentially where we believe we are building for the future. But I think these are times where you go back to your drawing board and look at where you can further extract more efficiencies. Inherently, as a business, what we've seen is while there is a winter in funding, but I think business out there is very thrived, right? I mean, clients do want more trucks, clients do want more delivery partners working for them. And I think as long as we're able to control costs and explore the extended runways for each and every company of us, logistics inherently is an industry which where there is enough need for organizing the industry as such. So obviously, all of us have we are quite cautious right now as we speak about every expense that we're doing. But we are hopeful that the industry will tend to kind of mature and organize, where a lot more of our companies do come in, the newer ones, as well as all of us scale up further, probably a couple of X over the next few years.
Thanks, Pushkar. Ankit, let me kind of pass that question to you. How do you manage growth, and is there a change in the tone from grow to profit? Sorry, Ankit, you're on mute.
Yeah, so definitely, as Pushkar rightly said, that there is a bit of a caution that we as a company, plus the brands that we are working with, plus the companies that we are working with are having. So people are much more focusing on customer retention rather than acquiring newer customers and burning their money on getting more customers at a higher cost. They are putting more money into servicing those existing customers and getting more, you can say, a cohort level, better metrics. And that's how we are also focusing on cost. Not per se that our costs are very high. We have optimized our cost to the best possible extent. And definitely we are investing much more on building newer technologies and newer products that can definitely help other brands that we are working with bring down their own costs and kind of build their relationships better with the end consumers that they are working with. And the funding winters are kind of a cyclic change that will happen and has to happen any now and then. So it's better for brands to get prepared before the winters are coming than between the winters. Yeah.
Mukesh, you've probably looked at more P&Ls and balance sheets in your career than collectively, I think, everyone in this conference. So tell us a little bit about the tone from investors. Is it more emphasis on profit now than growth? And how are you seeing companies focused on the bottom line?
Yeah. And Sankalpa, that's a great question, and I would kind of just pick up the threads from where Puskar has left it, right? So clearly, I think when we talk about logistics, last mile logistics, and startup companies, actually there is always some sort of a settling in time, where which even the investor community understand that there will be a couple of years of settling in time where you would need to establish the business, scale up, do customer acquisitions, and what Ankit also mentioned. Once you kind of reach a scale, right, then really there has to be a shift in strategy to kind of focus on customer redemption, customer retention, bring in all sorts of efficiencies and turn profitable. So I think, burning cash, the question that investors have really started asking is how long you can burn the cash. So, now obviously the period can vary, but clearly I have seen that shift in the last year or two, particularly since the time the COVID has started, that, okay, so as the money and, the business really has to be profitable. So, I mean, it's a call, and I'm just also, Sankalpa, linking this point to a couple of other points which we kind of discussed earlier. Let's say if for Puskar, if he has to make a choice that, okay, can he be turned profitable basis the existing operations, or he can keep on expanding, from a regional player to a pan-India player, but that really requires more. If he really asks the investor, they'll say, you rather focus on what you have on your plate and turn profitable. So there is clearly a shift in the mindset and the expectations that I've seen from the investors community.
Arvind, you've recently raised funding, done an acquisition. Are you more circumspect about growth? Are you focused on profitability? What's the outlook that you see?
Fundamentally, our DNA has been to focus on profitability, and we've focused mostly on unit level profitability across our every facility and across every customer acquisition that we do. Largely, this has helped us in terms of ensuring that we've continued to remain EBITDA positive pre fundraise and post fundraise. And from an investor standpoint as well, I think we are completely pro that while we are growing at a faster pace. We are trying to keep cost in control, at the same time ensuring that we don't lose sight on our unit economics. So I feel that's the path. There is always a need to revisit in terms of what is it that we want to do. The acquisition is largely helping us from perspective of further optimizing and digitizing a lot of loose ends that we felt that we could improve and bring about a larger synergy across the whole ecosystem that we are there. So that's unit economics is a key driver for us, and we kind of the team is also aligned that every customer that we work with, we need to ensure that we are not losing sight on to what extent we would want to bend.
Videsh, you've gone IPO recently. How has life changed, and what's the advice that you would have for not just your panelists, but also some of the participants on this call on what they need to do to prepare for an IPO?
So at one level, it does, of course, feel like a completely new innings, in the company's journey. Right now, you are answerable to the larger public, right? So in that sense, we're truly discovering what it means to be public. We understand that there will be even greater scrutiny in terms of how sustainable the business is, the profitability, and so on. And I would say that, you plan to IPO when you're confident of that story, because all said and done, I think it is, and it is far easier to, I would say, manage the venture capital side of the world in terms of, in terms of a story, a vision. But the moment you're in the public markets, it's a whole different ballgame, right? So I think I would say that when you're considering to go for an IPO, you do it when you believe that the company's reached that level of maturity. And if it's not reached that level of maturity, sticking with private capital market is probably the best way to go, right? Because the public markets can be extremely unforgiving if you have a few quarters of bad results and so on and so forth, right? But otherwise, frankly, life has not changed. We've always been a business that's been focused on focused on growth, has been focused on profitable growth. Our governance structures and all have always been, very strong. So as long as you have those pieces in place, those are not things which, because we've now become public, there's any added pressure. So it's just that I think collectively we all feel that we are far more responsible now. Not to suggest that we were not earlier, but when you're public, I think you feel the weight of that. You do feel the weight of that.
Thanks, Jadesh. So Jadesh talked about sustainability from a profitability standpoint. Let me kind of open up this discussion to the other sustainability angle, which we've seen a lot of activism and interest on, which is around emissions and net zero and ESG. So Ankit, what are your plans to create more sustainable and renewable logistics for your customers?
Yeah, so definitely we are working towards that, and we are pushing brands to switch to green packaging and kind of give them kind of solutions to procure these kind of packaging solutions, so that at least the plastic waste and unnecessary waste that is generated through e-commerce can be minimized to a certain extent. And definitely we are also working in developing some technologies that can reduce the overall number of attempts, the overall delivery cost for the last mile partners that we're working with. So that's our kind of 2 cents in reducing the number of the emissions overall.
Pushkar, are you going to go 100% EV in the next 5 years?
So we do have very bullish aims on going electric. However, the challenge is on the higher capacity trucks, the product innovation hasn't happened, right? I mean, it's a laggard curve over there. But yes, for smaller capacities, we are exploring assets, and we've been pursuing our journey of electrification about 2.5 years ago. So a significant chunk of our fleet even today is electric, and we've been able to partner with most OEMs out there in order to kind of make it as a go-to market and acclimatize truck owners or truck drivers to kind of familiarize themselves with this technology. So yes, we would want to go 100% electric, provided product innovations happens at the same pace at where our ambitions lie. So for the smaller capacities, even today we have a significant chunk of about 10-15% electric vehicles that are operating on our network. On higher capacities, we are working with a few OEMs, giving them our inputs that we at least kind of have it from our ears on the ground. And we are fingers crossed, hopeful that products would be innovated at that spectrum of truck types as well.
So Mukesh, question for you. EV is still not on par with ICE as far as capital expenditure is concerned. If you look at TCO, perhaps it is. And given this stress on profitability and returns, how do you balance this need to be more sustainable with this kind of ask to generate higher returns for investors?
Yeah. No, so Sankalpa, I think quite an interesting question. So, I mean, if you really look at and, with the growing retail and e-commerce and all, and it's kind of just reading a research report recently, there's a need to add almost like more than 150,000 trucks over the next couple of years. Now, as Pushkar mentioned, currently, let's say his fleet is 10 to 15% EV. and there's a long way to go there. Now, on the other hand, if we really look at the e-commerce players, be it Amazon, Flipkart, and others, all of them, they have kind of started making commitments, right? And, significant commitments that they want to, go for EV, by 2030. Obviously, this is going to be a gradual process. Now, as as a fallback of that, even the logistics companies, I mean, they have also started thinking, their own strategy on how do they, adapt the electrification of their vehicles. But, when it comes to that, and you kind of touched upon a very important point, because, it is always a choice. I mean, on the one hand, obviously, it's a must if their customers have kind of making those commitments, the logistics companies will have to kind of follow. But at the same time, it also, Sankalpa, comes with a set of challenges. And if I can touch upon 2-3 key challenges which are there, as we speak. The first one really is the whole charging infrastructure. Right? Now, as a solution to that, this last mile logistics companies, they have a large fleet of vehicles. It's kind of possible if they take a lead in kind of either owning or managing the charging infrastructure. So a large part of the problem kind of can be taken care of there. But the bigger challenge that I see is this whole last mile trucking on the supply side is quite a fragmented market, right? Because most of the logistics player, they have asset light model. They kind of rely on sourcing the vehicles from outside. And most of the vehicles are kind of owned by drivers, I mean, individuals. So how do we kind of bring the awareness amongst those drivers, them to go for EV? I mean, that's really a big challenge that I see. And if you think of a solution, maybe there has to be a shift in the strategy as well, where let's say a part of the fleet needs to be owned by the logistic player themselves. But then again, it comes to capex and investments and the profitability question that kind of really comes in. While, I mean, the other aspect which I'd like to highlight is if you really look at on the one thing is higher capex, but on the OPEX side, this whole adoption of EVs can really help the logistic player to kind of gain efficiencies on the cost side, because from a running cost and OPEX perspective, EVs are going to be far more economical, compared to the traditional trucks. So I mean, those are some of the thoughts that I have on this.
Jayesh, let me come back to you. If you were to electrify 100% of your operations, you could perhaps give birth to a whole new unicorn on the EV side, right? What are your thoughts on doing that? And what are some of the challenges you see?
So, Sankalpa, on this, I'll just zoom out to the larger sustainability question, right? I do think that we're only focusing on EVs as the means to position yourself as more sustainable, or essentially say that we're more sustainable, is a little distracting, right? And I think, and to what a couple of the other panelists also mentioning, right? Today, I mean, let's just remember where we are, right? We are at a position where there are only so many models as far as three-wheelers or two-wheelers are concerned, which are tested and safe and make sense from an operational standpoint. Four-wheelers, almost non-existent as far as the sector is concerned. So from an adoption standpoint, what in reality is going to happen, is my view, is that we are going to see traction as far as the three-wheelers are concerned, and we are going to see some degree of traction with respect to two-wheelers, that too in probably the metro tier 1 kind of locations where all said and done, the run distances are lower, right? Of course, there's a larger question that, I do think of, which is, in a country where your electricity per se is only so green, it does bring about a question of how much sustainability are you really achieving, right? And this is sort of like an open thought out there, right? We keep discussing it internally, saying that, at some level, and that's why I said EVs are sometimes distracting, because, there are clients also say, hey, what percentage of your fleet is electrified, and so on. And that's become a sort of a proxy for sustainability. I'm not very sure that that is the right measure of sustainability. I would, personally, and this is a personal opinion, not Delivery's official stance per se, but I would personally prefer if there are standardized measures which say, hey, what is your emission per parcel? Or what is your emission per ton? That actually makes a lot of sense, because in real terms, if I were to talk about sustainability, it's really about reducing emissions, right? A lot of our large facilities actually have very large captive solar plants. That makes a difference. When I'm running trucks, and we run 2,000 plus trucks, every single day, right? So these kind of, when you're in a position to use far more fuel efficient trucks, when you're able to invest, that is actually what's going to make a bigger difference in terms of reducing overall emissions. When you look at a company like ours, right? I mean, not to suggest that EVs are not going to make any difference, but I think we're very far away from being able to see the true benefits and potential of it. And to a certain extent, I fear that it's becoming a bit of a distracting metric. And if someone were to really look at the overall piece, it may not even really be adding up from a sustainability standpoint. That's personally my view as far as the whole EV piece is concerned. And of course, I agree that, companies like us, if we were to say, hey, I'm going to electrify my entire last mile, every rider on a two-wheeler is going to become, electric vehicles and stuff. Sure. But it's not very practical at this stage, right? And for various other reasons I mentioned, I'm not even sure whether that lends itself to true sustainability. The effort to make that happen will be significantly higher for what might possibly be much lesser impact compared to some of the other changes that we can make as far as the entire, the entire chain is concerned. That's personally my view on sustainability.
Thanks. I want to come to another challenge which often is seen in the industry, and that's the quality and availability of infrastructure and assets, right? So many of you run asset light businesses and you rely on third-party providers, either for fulfillment centers or for your transportation assets, right? And especially as you go down into tier 2, tier 3 cities, that does become a challenge. And let me start with Arvind, right? So you're in 8 cities. How challenging has it been to run or set up fulfillment centers? Did you get quality infrastructure, or do you think that there needs to be more that needs to get done?
As far as the outskirts of most metro cities, the infrastructure is getting better. I wouldn't say that most infrastructure is up on par what we would want to envisage. But largely, most cities where we have, they are larger clusters of warehousing complexes which have which have good infrastructure. Your cities like Delhi NCR, Mumbai, Chennai, Bangalore per se, largely don't face challenges, but we do see that some of the facilities on the eastern side, probably we could expect to see a much better infrastructure. Besides that, most of these locations have also become dense in terms of movement of heavy goods. And from that perspective, whether the road infrastructure lends onto it or to facilitate, currently we are still in that journey per se, I feel, where it's evolving. The road infrastructure is getting better. Government is investing in terms of ensuring that these road assets are expanded so that it can accommodate more traffic per se. And from a warehousing standpoint, I think at least we are excited about one of our new facilities in the Wellspun compound in Bhiwandi, which kind of is setting its tone in terms of sustainability and what it has to offer. But I think the larger traditional setups will eventually, in its journey, keep evolving, I feel.
Thanks, Arvind. Pushkar, let me kind of flip that back to you. Availability of quality infrastructure and assets. How has that played into your decision to go asset light versus asset heavy?
Right. So Sankalpa, when we started this firm, there was this hypothesis that trucking is an oversupply industry, at least in the smaller capacity of trucks. Right. So we primarily deal with trucks which are called as small commercial vehicles and light commercial vehicles. There is an oversupply into the market, and hence we chose to kind of be an aggregator, largely to not create further inefficiencies by adding more assets into the market. So when you trace back the growth rate of freight in India, which has been, let's say, about 10 or 9.5%, you have added trucks in India at 10.5% CAGR for the last 30 years. So you've just widened the gap of inefficiencies which has been existing out there. So that was the hypothesis of why we chose to be aggregators. Now, being an aggregator comes with certain benefits, and obviously the flip side also exists. The benefit is you can choose and rate drivers basis their performance. What it ensures, to an end client of ours is that they'll always consistently get the top rated drivers in our network. And because it's an oversupply industry, you can choose to use both carrot and stick to blacklist a driver if he's not performing well. And hence, as an aggregator, you tend to bring in further or a high degree of governance into the entire otherwise unorganized market. So that was the whole rationale of why we chose to be aggregators. What we believe in was these individual fragmented truck owners did not have access to enterprises, right? So most of them can actually see a DMart's warehouse. But when you look at the entire complex buying process of DMart, he has to figure out who a procurement manager is, who is the sales manager, who is the finance manager, so on and so forth, which makes it a glass ceiling for an individual truck driver to expand his universe of demand, which is available out there. So what we did was we digitized all of these entire enterprise buying processes and presented to them on a smartphone application. Now, all a trucker has to do is just start trip and stop trip, and he gets access to a whole universe of, let's say, 200 to 300 enterprises, which otherwise was inaccessible to the guy. And that benefit allows us to maintain both the quality levels as well as earning levels of every participant into the marketplace. So those are some benefits of being asset light, tech enabled aggregators, where you're incentivizing and penalizing the right behaviors on the platform, which in some format or the other benefits even the end customer, not just the client who's ordering truck from us.
Thanks. Let me open this up to some of the questions in the chat window. If others on this conference have any questions, please do type them in, because we'll try and address as many of them as possible. Let me start from the top. I think there's a question on productivity per delivery agent and what that journey has been like. So let me maybe ask Jidesh to answer that.
Yeah, hi. So, I mean, I wouldn't like to share exact numbers, but productivities per delivery agent is, of course, increased substantially over the years. And there are a variety of factors that have contributed to it. One, of course, is the fact that, as the network, as our own network expands, we've followed a philosophy where in many of the locations, when I'm saying metro, tier 1, tier 2, we try to ensure that we have a distribution center, which is at least 5 to 6 kilometers away from the customer now. So it's a rather dense network model that we follow. It's been a conscious choice to follow a dense network model. And overall density of parcels have also increased, right? So our network has become more dense. The parcels have become, there's increased density in terms of where you're delivering. To a certain extent, of course, the sort of constant innovations that we do in terms of making the app and so on more intuitive helps. And the larger ecosystem has also helped for that, because it's, all said and done, we have riders who are experiencing this with various companies, right? And you're far more well-versed with the nuances of delivery. So all of this, I think, has fundamentally contributed to higher productivities. We're well aware. I don't know what the cap is and whether even talking averages makes any sense in this business. But obviously there is some limit, because we're talking about a human on the other side who's got a finite amount of time, finite amount of energy to do a job, right? And as a company, we're well aware, sometimes even we face a little bit of that backlash, right? There are concerned citizens out there who do post pictures on social media saying, hey, is this right? Look at this rider going with 3 bags and so on, right? We're cognizant of some of the challenges of that. So yes, overall productivities have increased. I think it's, for the factors mentioned that have driven productivities up. I don't know how much more headroom is there. but we're also very aware that we are possibly at fairly high levels already, and there's only so much room at a productivity per delivery boy, assuming the standard modes of delivery. Now, if you throw in things like lockers and a few other things into the mix, those could, of course, change things, but that's where we stand.
Thanks. Let me maybe address another question, which perhaps is more relevant to you. What kind of criteria do you have for hiring of delivery boys? And what's a good retention percentage that you're looking at? I don't know if you want to share numbers or just give broad guidance.
I would love to be in single digits, and I'm talking month-on-month attrition, but we're far from that. And I'm told that that's pretty much what the industry also grapples with, comes back to the problems we discussed as far as attrition is concerned. Criteria is, the bar is not very high, and that's a good thing because essentially it allows a very diverse set of people to be available. So we want this to be income generating opportunity for a wide range of people, right? You're someone who has 2 hours to spare in the day, you're a student, various segments, right? So the bar per se is not very high. Our thought process is that, and also at the scale, right? Our thought process also is that we cannot be depending on local geography knowledge, local language knowledge, or intensive training for process. I'm strictly talking about the last mile delivery piece. The answer slightly varies if you're talking about some of our in-center processes in our processing centers and FCs and so on. But for last mile, the thought increasingly is that it'll be impossible to scale if we set any kind of such criteria or bar, right? Of course, there are some basic sanity checks. A person needs to have a license. That's assuming he's using a two-wheeler, which is not the case all the time. So such sanity checks we do. The online authentication layers that are getting built helps accelerate even that part. So we are able to today do background verifications far more quickly to ensure that the DLs are valid, there's no court case, and such things, right? Such hygiene checks. So those are really the criteria. Beyond that, the thought really is that we should ensure that the app that the rider uses is made more and more intuitive so that we can deploy large numbers of people, have flex capability, and people do not need to be necessarily trained or have a unique skill set. That's really the thought process. Of course, if the person also has better, like in some pockets, local language capability, better geographical knowledge, his productivity will increase. There's no doubt about that. We are not taking that away from the person, but our approach is to essentially build to not make that a factor. That's really how we're looking.
Got it. Pushkar, let me ask you this next question. It's a specific question. Given that you operate an asset-light model, how do you ensure that your vehicle is available to pick up goods from the warehouses for last mile delivery, and ensure that what happens to most of us with some of these taxi ride-hailing apps on frequent cancellations does not happen in your case as well?
Absolutely. So I think, I'll be wrong in saying that cancellations do not happen. I think if I were to not quote an example of today's scenario, but about a year ago, whenever a driver would cancel upon us being an Uber customer, we would be reassigned another cab from their own network, right? So that's the benefit of being an aggregator. So a pointed answer would be, looking at our historical engagement with our different clients, we predict the number of trucks which needs to be activated in a particular micro market, right? And that's how we kind of send push notifications. We look at engagement metrics of how many times our apps have been opened by trackers, so on and so forth. And that data allows us to build in a reliability of a little over 95%. So we still have a failure rate of 5%, but when you compare it with where industry was, that was a little tad lower than 70%. So that's our quest to improve our fulfillment rates as well as reliability. But I think a lot of it goes into play where you're understanding personas of truck drivers, which is, for instance, the relatively middle-aged folks are willing to log in early morning, right? But the younger lot who are driving trucks and who are people who want more flexibility in life, you can activate them probably in the later night pickups and so on and so forth. So these are few insights when you go on mapping with different personas of your user. You build into your algorithm to send push notifications to the right set of folks, so on and so forth, thereby improving the pickup rates of transactions, fulfillment rate, and even ensuring that the entire completion of transaction happens, right? So there are a few legs to a particular transaction wherein a person needs to look at a transaction, be excited about it, apply to it, and then finally render services. So we constantly monitor the entire drop-off across the entire stages of a life cycle. And that allows us to be a little more better than where the market is, to be honest.
Ankit, you want to add to that on technology, value-added services, availability? How do you kind of manage all of this in an asset-light model?
Yeah, so mostly we have developed APIs and tracking tools to provide transparency to the end consumers. So through multiple touch points, that is like we reach out to them on WhatsApp, mail, text messages, and let them know about you can say the EDDs, the estimated delivery dates, and any changes into that due to any XYZ reason that is happening on ground in the logistics network. And in case any you can say any failed attempts happen, or in case any you can say they want to reschedule the delivery, so all that is automated through technology, and this is reliable to the logistic partner that we are working with, so that at least on-time deliveries can happen, the number of RTOs can be reduced to a better extent, and at the end the number of attempts can be optimized on that part. So we are working closely to actually develop these tools so that at least our sellers and their end consumers can be happy and can actually retain their own customers.
Okay, there's a question which has just come in. I'll kind of read it out. You have multiple categories within B2C e-commerce, including farm fresh products. How challenging is it to manage the on-time delivery of fresh or farm fresh items? If anyone wants to take that question. Pushkar, do you serve? Yeah, go ahead, Jadesh.
Sorry, so I'd like to add into this. Yeah, so it was Ankit. So it's actually pretty difficult to expedite the delivery of farm fresh products, and the major like the chunk of the demand should happen from nearby areas only, so that at least it doesn't get spoiled on the way. So that's the most important thing that one has to take into mind, so that at least the rest of the goods are not spoiled and these products reach fresh to the end consumers for consuming. And so at least this is the point that anybody who wants to sell these farm fresh products online should keep into mind. Yeah.
Pushkar, I think you may have a better answer on farm fresh specifically. Yes.
So we do work across sectors, and farm happens to be one of them. We do both input, which is inbound, picking up from farms, as well as outbound deliveries for clients. Perishable is a very challenging category, and our reliability levels over there are north of 98%. Yet we, kind of get slapped on our back for those 2% of time when we fail. But interestingly, I think that's also a point where people want to move towards more organized platforms, right? Because when we are able to sustain a 98%, traditional markets are at 70, 75%, right? Which is why historically farm and groceries have been a low margin categories. Your wastages are extremely high. Now, I wouldn't take a lot of credit for that, but because our clients are doing a better job in maintaining those inventory and perishable levels. But as a logistics operator, what we do have to maintain is our buffer capacities in and around that region has to be really strong. We do more predictive monitoring of what's happening on those trucks and have geofence the entire path for them. So what it technically means is you can proactively identify any failure rates which is occurring over there, which is not the case in a non-perishable environment. So to kind of nail that farm fresh deliveries, I think what happens is if you stagger your supply chain, wherein you have built in some buffer capacities on both supply side as well as any leakages which have happened in between, allows you to build in. I mean, it definitely comes at a cost of redundancy, but it allows you to deliver a better service level at the back.
Thank you, Pushkar. I think we are at the close of the session. I'd like to thank all of you, Arvind, Mukesh, Pushkar, Jadesh, and Ankit, for a wonderful, insightful session. And let me hand back to Hari for the close.
Thank you so much, Sankalpa. Even I was curious, how would we kind of, host a 1.5 hour session? You've done it brilliantly well. So thank you so much, Sankalpa and Mukesh, for having us over.
Thank you, Mr. Sankalpa. We have one last question now. Sorry. The question is related to high value and low volume products. Actually, they have customers, but finding the last mile logistics is very difficult. How can we address this?
Sorry.
high value, low volume, how do you address
Yeah,
that
actually,
specifically?
they sent the question directly to the host.
Okay.
Okay, it's not in the chat box.
Can you paste it on the chat box, sir? I did just allow
Yeah,
this.
sure, sure.
Thank you.
Yes.
Maybe I'll request Ankit if you can share some thoughts on that. High value, low volume products. How do you kind of offer last mile logistics to these kind of customers?
Yeah, definitely one aspect of this is that in case the product value is very high, so it's better to have an insurance in place and definitely put it through either third-party insurance, or many of the logistic companies are also providing these kind of insurances. And in case anything bad happens to the product or it gets lost or damaged on the way, so this is one aspect of it. And the operational intricacies that basically the logistic companies follow in dealing with these high value products, I think so Jidesh would be in a better position to answer that. So how that happens. Yeah.
Sankalpa, if I can take a stab on this.
Go ahead, Mukesh.
Yeah. No, so, one of my client, happens to be jewelry e-commerce platform. So they deal in the real gold and diamond jewelry. So that's really the high value, low volume, right? So the real gold and diamond jewelry. Now, what I've seen, what they've done for this whole delivery, two things. One, they have done a tie-up with the express logistics company, right? Because and the second thing is where what they've looked at is having a tie-up on a pan-India basis. So a large express logistic company which has presence on a pan-India basis, because you would really need a partner, a logistic partner who really understands the risks associated with it, right? And there can be some sort of a standard operating procedures for delivery throughout the country. So I think I'm just thinking more from that company's perspective, how they kind of deal with it. So there's a very defined standard operating procedures agreed between the logistic company and the company with an agreed TAT, the turnaround time for that. So that's what I have seen.
Happy to take this question. I was briefly associated in that particular segment in my earlier assignment. So there are very limited companies who handle valuable as a category. One is BVC, which is one of the largest players in valuable cargo logistics. Second is Sequel. Third is DHL. To some extent, they are still figuring out on the whole last mile logistics. The infrastructure required for it is rich. You need, depending on the kind of values that you are handling, one, you need a vaulting facility. You may possibly require, we had invested in armored vehicles with gunmen, which would accompany each movements that we do. There would be almost 3 or 4 trips of movement that would happen between Surat to Mumbai, which is a very large diamond market. And probably someone may want to look at a company like BVC, which is curated solutions, not only for domestic, but also international logistics. Where on the very high value, where the ticket size could be above 50 lakhs to a CR, and on the e-commerce side as well, they've curated solutions where you could have a 7-day delivery, 12-day delivery, from your facility until the last mile. Largely, a lot of these solutions for international are curated for Europe and the North American markets. The cost is pretty high. The coverage that they may have in a country like India is limited because jewelry still, as Ankit pointed out, you need an insurance cover. The risk associated is high. You may not want the delivery boys to be off payroll. You would want them to be part of your payroll. You may want your vaulting facility in each of the locations where you're catering, which kind of helps you secure an overnight storage as well. So Probably these are three options that are there, and but the coverage in India is not extensive for these carriers.
Thanks, Arvind. Hariharan, back to you.
Thank you, Mr. Sankalpa. I would like to thank all the panelists, Mr. Mukesh Agarwal, Mr. Pushkar Singh, Mr. Jitesh Haridas, Mr. Arvind Shivakumar, and Mr. Ankit Kaushik. Thank you. On behalf of CI Startup Center, I would like to thank PwC for associating with us for this ICONN for last year and also continues the partnership this year also. Thank you, Mr. Sankalpa, for the wonderful session. Thank you.
Thank you, everyone.
Thanks, Ariel.
Thank you so much. Pleasure. Nice connecting with you. Thank you.
Thanks, everyone. It was a pleasure. Thank you.